This video covers internal control, so let's get started. The primary way that fraud, as well as unintentional error, is prevented, detected, or corrected in an organization is through a proper system of internal control. Internal control is a plan of organization and a system of procedures implemented by company management and the board of directors. Internal control is this plan, as we said, of organization and a system of procedures designed to accomplish the following 5 objectives. Number 1, safeguard assets. A company must safeguard its assets against waste, inefficiency, and fraud. 2, encourage employees to follow company policies. A proper system of controls provides clear policies that result in the fair treatment of both customers and employees. 3, promote operational efficiency. Effective controls minimize waste, which lowers costs and increases profits. 4, ensure accurate, reliable financial accounting records. Without proper controls, the records may be unreliable, making it impossible to tell which part of the business is profitable and which part needs improvement. And finally, 5, comply with legal requirements. Effective internal controls help ensure a company complies with the law and avoids legal difficulties. How critical are internal controls? They're so critical that the U.S. Congress passed the Sarbanes-Oxley Act, or SOX, which applies to public companies, which are those companies that sell their stock to the public. Among other things, SOX requires these companies to maintain systems of internal controls that are adequate to prevent material misstatements in the company's financial statements. In addition, each public company CEO and Chief Financial Officer, or CFO, must certify in writing that their company's annual and quarterly reports are accurate and complete, and that their internal controls are adequate to prevent material misstatements in the financial statements. Stiff penalties and prison time await SOX violators. 25 years in prison for securities fraud and 20 years for an executive making false sworn statements. A system of internal controls consists of 5 components. 1, the control environment. The control environment is the tone at the top of the business. It starts with the owner and the top managers. They must behave honorably to set a good example for the company's employees. Number 2, risk assessment. Assessing the risks a company faces offers hints of where mistakes or fraud might arise. A company must be able to identify its business risks and establish procedures for dealing with those risks to minimize their impacts on the company. Number 3, information system. The information system is the way that accounting information enters and exits a business. The owner of a business needs accurate information to keep track of assets and measure profit and losses. Number 4, control procedures. Control procedures are built into the control environment, and information system are the way companies gain access to the 5 objectives of internal controls we discussed previously. 5, monitoring of controls. Monitoring provides eyes and ears so that no one person or group of persons can process a transaction completely without being seen and checked by another person or group. So on that last slide, we saw that one of the components of an internal control system is a set of control procedures. These internal control procedures could include 1, smart hiring practices. Good internal controls start with a company's hiring practices, which should include clearly defined job descriptions that ensure all important jobs get done. Background checks should be conducted on job candidates prior to their being hired. 2, separation of duties. An extremely important aspect of internal control is separating 3 key accounting duties: asset handling, record keeping, and transaction approval. Accountants must not handle cash, and cash handlers must not have access to the accounting records. If one person has both cash handling and accounting duties, that person can steal cash and conceal the theft. For companies that are too small to hire separate employees to do all of these functions, the key to good internal control is getting the owner involved. 3. Comparisons and compliance monitoring. No person or department should be able to completely process a transaction from beginning to end without being cross-checked by another person or department. 4. Adequate records. Accounting records provide the details of business transactions. The general rule is that all major groups of transactions should be supported by either hard copy documents or electronic records. 5. Limited access. To complement the segregation of duties, a company should limit the access employees have to assets based on their job responsibilities. And finally, 6. Proper approvals. No transaction should be processed without management's general or specific approval. The bigger the transaction, the more specific approval it should have. Now we will look at a few specific controls. Cash requires some specific internal controls because it is relatively easy to steal and it is easy to convert into other forms of wealth. Also, most transactions ultimately affect cash. Here we are talking about the internal controls for cash receipts over the counter. The point of sale terminal or cash register provides control over cash receipts while also recording the sale and reducing the inventory for the appropriate cost of goods sold. For each transaction, a sales associate issues a receipt to the customer as proof of purchase. The cash drawer opens when the sales associate enters a transaction, and the machine electronically transmits a record of sale to the company's main computer. At the end of each shift, the sales associate delivers the cash drawer to the office where it is combined with cash from all other terminals and taken to the bank for deposit. Later, a separate employee in the accounting department reconciles the electronic record of the sales for each terminal to the record of cash turned in. These measures, coupled with oversight by a manager, discourage theft. The next cash control we will cover are the controls over cash receipts by mail. All incoming mail is opened by a mailroom employee. The mailroom then sends all customer checks to the treasurer, who has the cashier deposit the checks in the bank. The remittent advices go to the accounting department for journal entries to cash and customer accounts receivable. As a final step, the controller compares the two records for the day. 1, the amount of the bank deposit prepared by the treasurer, and 2, the debit to cash made by the accounting department, which should equal the amount deposited. The next cash control we will cover are the controls for payments made by check or EFT and electronic funds transfer. Companies make most payments by check or with an EFT, which provides a record of the payment. The check must be signed by an authorized official. The EFT must be approved by an authorized official. So remember, for smaller companies, having the owner or chief executive officer reconcile the monthly bank statement or make the bank deposits can help strengthen internal control. A petty cash fund also has cash controls on it. It would be time-consuming for a company's treasurer to write separate checks for small amounts of money the company spends. Instead, companies keep a petty cash fund. The word petty means small. That's what petty cash is. A small cash fund kept by a single employee for the purpose of making such on-the-spot minor purchases. For example, petty cash might be used to reimburse an employee for donuts purchased for a morning meeting or to pay a postal employee a few cents due on a letter received by the company. There are limitations to internal control. Unfortunately, most internal controls can be circumvented. Collusion, 2 or more people working together, can beat internal controls. Another way to circumvent a good system of internal controls is for a top manager to override them. Human limitations such as fatigue or negligence can also circumvent a good system, or it can gradually deteriorate over time if control procedures are neglected. The stricter the internal control system, the more it costs. An overly complex system of internal control can strangle the business with red tape. How tight should the controls be? Internal controls must be judged based on their costs and benefits. For example, a part-time security guard at a store might cost about $22,000 a year. On average, each part-time security guard may prevent about $50,000 of theft each year. So that would lead to a net savings to the company of $22,000. Okay, that's it. We're done with this one. This video was created and narrated by Dr. Wendy Tietz. Have a great day.